FM. And the floor is yours, Dave.
Okay, good evening. My name is Dave Morrison. I'm the Executive Director of the UDT SEAL Association. Welcome to our second seminar in the Wellness for Life series. For those of you who missed our first seminar, Demystifying the VA Loan, we have actually hung it up on the UDT SEAL Association Facebook page as well as the members page. Tonight, we are pleased again to have Michelle Crumley and Ben Smith from Caliber Home Loans. They're going to share some thoughts on income with regards to the home purchasing. The discussion will center around what you can claim, what happens to your income while you're transitioning, as well as passive income, spousal income, and the likes. In order for you to make the most effective use of your time, post any specific questions you personally have in the chat so that Ben and Michelle can address them accordingly. And without further ado, I will turn it over to Ben and Michelle, and they can take it from here.
Wonderful. Thanks so much, Dave. And before we hop in, for those that are new to Zoom, especially when there's presentations involved, I'm going to have my techie here beside me walk you through how to make this a little bit more friendly.
We'll try and make this a little easier for you guys. So some of the feedback we got on the last one was that the screen share took up most of your space. So we want to make sure that you know how to see us best. So if you're on a single screen, you can go to the top of the screen, you will see a pop-up that says View Options. So if you tap that, you can go down to side-by-side mode, click that, and then you should see the screen pretty large for where it says Wellness for Life Seminar Series right now, and then probably a tinier view of us. If you grab in between those two, there should be a slider bar where you can increase the size for us and shrink down the size of the screen, and as you see fit through that presentation, so you can kind of see what's going on. So hopefully that comes through here on the recording for you guys, and will work out all right. So we'll go from here.
Wonderful. So we are going to hop in, guys. And for those that are watching this time with us, but maybe weren't with us last time, I am Michelle Crumley. As a 30-year military spouse of one of the team guys that retired about 11 years ago now, this community is near and dear to my heart. And it is the military community that actually 20 years ago was the catalyst for getting me into this industry. And with that, it has been about educating and making sure that our community knows how best to prepare to be a homeowner, to go through the loan process, and then also what to expect before, during, and after. And it has been absolutely a hallmark for me to be able to then be part of this community in the education component. So that's just a little bit about me and the importance of what I feel that we get to bring to the table with this group.
All right. Well, guys, my name is Benjamin Smith. I grew up in Colorado, which a lot of people would think would mean a lot of skiing and hiking and all of that. In my circumstance, it meant growing up with a very disabled sister in a very poor family with childhood cancer issues, living in a group home, all of that. I needed an out from that, and I found that in the United States Air Force and joined up as a weapons loader on F-15s. That job requires a lot of precision, a lot of attention to detail and communication with a small crew, small team, working in total cohesiveness to get the mission accomplished, and make sure that the pilot's weapon does what it's supposed to do when it's supposed to do it. Loaded a lot of bombs, a lot of aircraft came back without those bombs. And looking ahead, I could see the writing on the wall that there wasn't a big civilian application for that kind of work. And I needed to find something similar, and I found that in mortgage. I have a small team with an assistant, a processor, an underwriter, working in careful communication to make sure that we deliver keys to a house. So that's why I'm here, and I hope we can pass some knowledge for you guys and get some information answered for you.
And one of the things that we always want to make sure, if nothing else, in any of the discussions that you partake with us or any of those moments that there are, is to know that what is most important is that you always find a well-educated and knowledgeable loan officer and lender when you are looking at home financing.
Right.
There are a lot of individuals out there that they'll say that they know military lending, or that they know lending, or that they know VA loans, but really going that extra mile. You know, we do our research, we do our workups when we're getting ready to go overseas.
Yeah.
We might as well make sure that we're doing that legwork when you're talking about mortgage. So when we were together last month, we really talked about the VA loan and the benefits of it, a little bit about the basics, as well as the myths, and we debunked those.
Right.
But this week, tonight, what we want to talk about is something that pertains to everybody. If you are thinking about buying a house, whether it's your first house, whether it's your second house, whether it is your 15th house that you're buying, whether it's an investment, or whether it is a second home or your primary, you've got to qualify for a mortgage. And there's this thing called income that pertains to everybody. So we wanted to kind of delve into that tonight. And it was interesting getting ready for this. I looked up what is the actual definition of income, right?
All right.
So income is the amount of money that you receive during a period of time in exchange for labor or services, sale of goods or property, and as a profit from financial investments. For us,
Pretty broad base.
Yep,
Right.
that's a lot of stuff. For the most part, right, what we're talking about is what we can use and what is that income stream that you have coming in. So tonight we're going to talk about military pay.
Yep.
We're going to talk about civilian pay. And we're going to talk about some of those passive type of pays that are out there. Because what is interesting, right, is not all income is created equal when it comes to mortgage lending. And part of that, a lot of it circles around to whether it's considered stable or not. What does stable income mean, Ben?
Likelihood to continue. I mean, that's the bottom line. Is the pay that you're receiving going to continue? Is there a good chance that that is there? Is there enough history leading up to that? And with that in regard, the general guideline is it likely to continue for 36 months. Is a line that the VA has drawn for a lot of that income. And so we'll touch on how that applies in different scenarios and situations as we move ahead.
Well, and I think that brings up a good point. As we talk about income tonight, we're going to give you some general rules of thumb that are pretty standard across all lending platforms, right? Now, there's always a rule to break a rule, but we're going to talk in theory about the generalities of what is and isn't acceptable, or what we'll call what's qualifiable and what's not. Because if you're getting the income, that's wonderful. But just because you've got that income coming in doesn't mean that a lender can actually use it when they're determining whether you can afford something or not.
From a philosophical basis, from a lender's perspective, it all comes down to the ability to repay.
It's the,
So,
hey dude, man, I'm still on that program that we,
then that'll put you in good shape for that. So I hope that makes sense. It's all about the ability to repay, and some income is really stable going back a step, and some of it not so much.
And we're going to talk about those differences and delve into a little bit of those that either you may have heard, you may have experienced, or you may come across. And I think that's important to be aware of. And then last, what we're going to do is we're going to kind of wrap this up. We'll probably talk a little bit about it as we're going through the different income streams, but we're going to wrap up with also talking about how does, when you're transitioning from the military out back into the civilian world, what that looks like, because that is a different animal in and of itself. So we'll talk about all of these things, whether you're in or you're out. And then we're going to kind of wrap it up and bring it home with talking about what does that look like in that in-between phase? Because I can tell you from my personal experience, it can get kind of interesting if you're not prepared for it.
It's a tougher conversation. and that's why it takes somebody like us that's gone through that with hundreds of families to get you across the finish line with that. We can make it work. So
absolutely. So I think because we are talking with the military community, that let's start with kind of what from that military income, right? That military pay that you get on a monthly basis that comes in your LES. What does that look like? What can we use and what can't we, and when? So tell me a little bit about the things that generally no problem ever utilizing?
All day base pay. It's on the screen, obviously, guys. Your housing allowance is obviously a pretty fixed amount, obviously different rates depending on whether you have dependents or not. And that is always based on the zip code where you are going. So if you're in a PCS and you're looking to go from San Diego to Norfolk and you're making your way out to Virginia, we have to use the zip code here, not that higher amount in San Diego that you've been enjoying. So we got to look at it that way, because that's what's going to continue moving ahead. So
So you mean that $4,000 that you're getting for BAH
Yeah.
in California is not going to be here in Virginia?
that's right. Yeah. Or and we'll get into, if you're overseas and you have COLA because you live in Germany, that's coming off the table when you get back CONUS. So that's definitely an issue. Food allowance, of course, is always there. Those two items, housing allowance and food allowance, are your non-taxable items. Tax is not deducted from those along those lines. So because of that, we actually have an opportunity when we are counting your income to gross those up. We can basically act, because it isn't being taxed, that a certain amount, all of it, a little bit extra is there. So it's kind of like a ghost income that's there, but sometimes that's the difference between getting across a finish line and not.
And some loans will let you raise it by 10%, some by whatever your tax.
Maybe by your tax bracket, but in general, in my experience with the VA, it's going to be 125% of that amount. So whatever,
At 25%.
whatever a quarter of that amount is, that you just tack that on top, and that's the total income that we'll look at. And this is the common pay we're going to see out of most everybody.
Mhm.
Not everybody is your community. Not everybody gets the other stuff that you guys get. So
But speaking about the other stuff,
Yeah.
so when we talk about specialty pays, what is unique, right, for our SEAL team community is that unless it's a rare duty station, for the most part, you're always, right, it's stable. It's going to continue for the next 3 years. Is your dive pay, jump pay, your
Safe pay,
hazard pay, all of those things we can count as qualifiable, stable income.
Right, because you're doing the same job. It's not like you're, we could foresee that you're going to start going to loading aircraft and all that would come off the plate. So, yeah.
But if you have someone that doesn't normally get those pays, that goes to a duty station where maybe for 2 years, they're going to get jump pay, can we use that?
There's no real way that we're going to see necessarily, in my experience, that they wouldn't get it afterwards. I haven't seen an underwriter dive that deep personally.
Sometimes you'll see it in the orders. And I think on the flip side, when you're going, if you are taking orders someplace else, look at them and see what they specify you're eligible for those special pays.
Right.
Absolutely.
Right.
One I get a lot is they'll show you, we'll have an individual show us their LES, and it'll have all of these crazy, wonderful, when you're PCSing, travel pays, right? So it's got malt and it's got all of the per diems and all of those special pays. Can those be used?
No, because it's not going to be an ongoing thing, and we can see that.
Yep. So those,
that's not going to be there. It's not gonna keep
temporary
in there.
situation.
Yeah,
there.
same with your clothing allowance. We don't take that into account and divide it up over 12 months necessarily. I mean, I'd fight that fight with an underwriter if that's what it came down to, but that $300 something probably isn't going to be the winning issue. Yeah, yeah, God forbid.
Yeah. If we need $300 from,
you're buying too much house,
yes,
and then it's a problem. Yeah.
So what I'm hearing is base, BAH, and your BAS. No problem. Remembering that BAH is based on either if you're PCSing where you're moving to, or if you're buying in your command area, then it's based on where you currently live.
And bear in mind, if you've been in a location for a while, typically, well, for example, in the peninsula here up by Langley Air Force Base and Fort Eustis, for those guys, they at one point saw a drop in their housing allowance for whatever reason. I don't know why. It makes no sense to me why it dropped, because it's not like anything's gotten cheaper. But in that circumstance, a lot of the families that were already in place were grandfathered into the higher amount. So they didn't experience that drop. That drop was there for people that were inbound. So we know how to look for the differences there. And that can be, a difference in just understanding all of this world. So,
yep.
Yeah.
So
right.
Then as we continue with some of the military pay, right? So once you are back in civilian world, whether you are one, retired, if you've done your 20 years, we know that there's retirement pay there.
Right.
If you get retirement pay, can we count that?
Absolutely.
Do we have to validate that it's going to continue?
No, it's deemed to, it's going to continue.
Yes.
We know that that's a perpetuity situation.
Yep.
So
So that is not having to then show that the likelihood of it continuing remains. It is a known that military retirement is indefinite,
Yeah.
as long as you're breathing.
it's a
And then VA disability. Can we use VA disability?
100%. And that's another non-taxable item that we can gross up a little bit. So that can make some difference there. So yeah, you get a disability rating. We absolutely want to know that, even if it's 0, because that can be a part of your funding fee. Harkening back to last month and the last series that we did here, the VA funding fee is not there for disabled vets. So if you have a rating, we want to know about that, and we can definitely count that income.
Well, and as we talk about, and we're going to, again, do a much deeper dive into that transition period, right? When you are separating from the military, if you're within that 12 months of, we know you're getting out, right? So either your ETS is showing that that is your separation date, you put in your paperwork, whatever that looks like. If we're within 12 months of an individual separating from the military, we can't use your base BAH and your BAS that you currently make today, or your special pays.
Right.
We can't use those.
That's right.
Because we know they're not going to continue. But we can do the math if you're retiring and figure out what that retirement income is, and can use that in lieu of those other pays.
Yep. Yeah, and obviously the retirement pay is only going to be a portion of that. Housing allowance goes away, food allowance goes away. It's going to be a piece of your base pay, and depending on how long you've been in. So it is basic math that we can figure out, but having that be enough, that can be another story. And we'll get into some of that here in a second, really.
Absolutely.
Yep.
The last thing under military pay that I know I get a lot of questions on, and I'm sure that you do as well, is if you've got someone that is either on their way out, or they are out and they are going to school using the GI Bill.
Mm-hmm.
And with that, in many cases, you get a fairly substantial BAH,
Sure.
right? Can we use that for qualifying?
Unfortunately not. Likelihood to continue for 36 months. So unless you somehow manage to perfectly time, I'm just kidding, you can't use it. You can't use it. They know it's going to end in the 3 years time frame. So it's just not going to be a thing. It's great that it's there. It definitely factors, I think, at least in an underwriter's mind from a common sense standpoint, if the debt to income ratio on paper based on income we can utilize is a little tight, they know that there is a cushion there for what it's worth.
And you hear them called compensating factors.
Compensating factor. That's right.
Yep. And with the GI Bill, right, it is contingent on you being in school, and there's nothing that requires you to continue being in school. So as soon as you stop, or maybe your grades aren't good enough and they tell you
you're the worst student ever, they're going to pull it from you.
So it is wonderful that you're getting it, but just know from qualifying for a loan that you're just not going to be able to use that for income. Okay, so let's move and talk a little bit about our civilian world.
Okay.
So this may be military spouses, right? So if you are still active and your spouse is working, we're going to talk a little bit about how that looks. And then it might also be yourself, whether it's a second job or whether it is now, again, you are out of the military and you are employed in the civilian world. So there are different ways that we get paid.
A lot of different ways people get paid in the,
So let's take the easiest one first.
Okay.
Let's talk about if you work for an employer, they take out, they pay you in pay stubs. You get a W-2 at the end of the year and they're taking out taxes. You are an employee. So you receive, right, whether it's you're given a salary or they're told that you get paid hourly and you have an hourly rate, but it's known. Can we use that, whether it's a spouse or whether it is for yourself personally?
100%. Obviously, we can use the spouse if they're on the loan. So just caveat, guys. We get some times where there may be a spouse that maybe brought to the table some really bad credit and they really make the file not work. In that circumstance, then if they're not on the loan, then we can't count their income, just to be clear. So as long as they're on the loan though, and they're working and everything else comes together, then yes, salary or hourly can work. Now, caveat there, full-time hourly, okay? Part-time, if you have a part-time job, we'll circle to that in a minute, but part-time jobs, you have to have a 2-year history of working part-time job in that field. Okay, so if you just got back to doing full-time and you still have that 2-year history, an argument can be made if we can explain the gap in income. But in general, part-time income only can be counted if there's a 2-year full history of having received it, because a lot of people get part-time jobs for a season or whatever, but we'll circle back on seasonal in a second too.
Perfect. So now with salary, let's talk about the PCS situation real quick and a spouse's income,
Yeah.
right? So you got orders, you're moving. I'm the spouse, I work, let's say we're in California, we're moving to Virginia. I work in California. Can I use the income I'm making in California here in qualifying for a home in Virginia?
It depends on the job. So if that job can be done remotely and the employer will say on the verification of employment that you qualify for remote work, then yes.
Okay.
Because you're going to continue to be able to do that no matter where you are. If it is a transfer within the same company to a different location that they have in the area that you're moving to, then yes, we would have to have, again, something from the employer stating that they have a position open for you at the new location. If you are leaving that job and you need to find something else in the new location, we absolutely cannot use what you were having for income to qualify prior to you showing up. So that leads us into the next phase, which is there a job lined up? If you have something lined up and you have an offer letter in there, then we may be able to use it. But if that job letter has a bunch of contingencies on it, then we're going to have to wait for those contingencies to be cleared. For example, your spouse is a pharmacy tech. They have been working for Rite Aid in California, and now they're going to be working for CVS out here because there's no positions for Rite Aid. They may make them take a certain board test for Virginia, whatever they need to take. If they have a qualifier like that, have to pass a test, have to whatever, and then we're not talking normal drug screenings or anything like that, but as long as they clear those contingencies, no problem, we can count that income. But we get into some tough logistics sometimes of having the house purchased prior to arrival. Is that going to happen or not? So that can get a little rough. So it takes a lot of careful individual planning on your situation with those circumstances.
When we're talking about W-2 employee, right? So we know we can figure out what you're guaranteed, right? Your salary or the hourly rate for that versus your guaranteed hours. When it comes to, hey, I get overtime, or I'm a commission employee, right? So a fair amount of my income may come from commissions, or I get an annual bonus. Can I count that as income?
Depends on your history.
Tell me more about that.
It depends on your history. If overtime just kicked off in last year for whatever reason, and you don't have prior history and you can't demonstrate prior history of receiving overtime, it's not enough time. We need 2 years history of that type of pay to count the overtime stuff. Generally the same with commissions. Now there are some loan types. I just had one with FHA where they just needed a year's worth, 12 to 24 months, but they needed a really good explanation and consistency to kind of show, that maybe that car salesman was, being consistent across that time frame, and it wasn't just in the last 2 months of the last 12 that they started really doing okay to count that. So it really depends on the history that we can show. So that's why it's important, for what it's worth, when you guys are gathering documents and you have those jobs. It's fine if it's an ADP and you can reference it anytime, that sort of program, but highly recommend you always keep a year-end pay stub. It will show that breakdown on the pay stub for overtime, bonuses, things like that have received. And if there is annual bonus, hey, you met goals or whatever, and every year they give you an extra $5K, yeah, we can count that, but we have to have the history. If it's the first year, it's not enough time to know if that's going to likely to consistently move ahead.
So what I'm hearing is when we talk about stable income, we are talking about, one, the likelihood that it's going to continue. And to factor in with the likelihood of whether it's going to continue, we have to look backwards to the history of whether we've received it or not.
100%.
Okay. And that's going to play through a lot in all the different types of income that are out there, right? That's going to be that standard that is going to be looked at. So this is W-2 pay. Now we have a lot of individuals when they get out, decide to do independent contracting.
Sure.
Or they, during the pandemic, may have started their own at-home business, right? Their own business.
Yep.
So we want to talk about, what does self-employment look like? Because that is a completely different animal. It also goes back to most businesses fail within the first 2 to 5 years. So when we talk about self-employment, so this is your 1099s, right? So maybe, you're not employed by and having taxes taken out wonderfully by someone else. You are doing it yourself, whether it's on a Schedule C on your tax returns, whether it's in your K-1 and your business returns and pass-throughs, all of those things. So we're talking about whether you're freelancing all the way to partnerships and LLCs.
Right.
If you are self-employed, it is really important. You have to at least have 1 year. And that's, again, very rare that that's accepted just in and of its own.
Right.
Is that they want a 2-year history to see, have you been successful? What's your average been? So what they'll do with your business income is they'll take your most recent 2 years tax returns, and they will take your profit that it can be counted, right? Your income from the business, and they will average it over the 2 years.
And on most simple basis to explain and understand that, guys, it's, if you have a business and you've structured it and you had $100,000 in gross income from that job, and then you tell the federal government you had $90,000 in expenses, you made 10 grand, and we have to believe you. We can't look at it any other way, basically. So we get into a lot of math with all of that stuff. It can be a very complicated ball of Christmas lights to unravel at times, and we're happy to do it. But it definitely is a lot of work to get through self-employment. So sometimes you just have to add a little bit layer of extra patience there. And I definitely would add a little bit of extra time and qualify. This is not the situation where you're going to apply online and have an answer in 15 minutes about whether you qualify to go buy a house. You need to give the humans a little bit of time to figure that out, get your income calculated perfectly, and what can and can't be used, and how that factors into your particular situation.
So what I'm hearing is that if I paid myself $10,000 a month for my business, but when I actually get around to doing my taxes, and I show that I only made $10,000 the entire year, you're going to use $10,000, not the $100,000 I paid myself. Okay.
The taxes don't lie.
Yeah. If you reported it to the IRS, that's what we have to use, isn't it?
Yeah, it's that's it. So if you are in those businesses, if you have a business and you are fresher at that, and you need to think ahead, if you're 90, if you're a year and a half out from making a big move or transitioning out, that is the time to really engage with a professional that understands tax stuff. Now, it is not a lender's lane. I will say that. I will not be the one to tell you how to file your taxes so that you qualify for a mortgage. I'm going to give you a general overview about what income can and can't be used in that scenario. But you got to work with a tax pro to kind of go through that. It's just not something I'm licensed for, and I have no business giving you that advice.
No, that's what CPAs get paid
That's
for.
right. That's right.
Mm-hmm.
Yeah.
So then, okay, so with self-employment, we know if you're departing from one employer and going into business for yourself, know that you're going to have a really hard time utilizing any employment income from your new business for 2 years, and plan accordingly for that.
Yep.
Okay.
Yeah, it's really the 2-year history, guys. Yeah, that's the main thing.
And then the last kind of on that civilian side that we'll see a lot, we'll see seasonal jobs, right? A lot of individuals maybe pick up some work I know when we were in Alaska, we had all kinds of people that would pick up second jobs during fishing season, right?
Okay.
They would come in and work with the canneries.
Right.
And you can count that as long as you can show that 2-year history.
Yep.
That you've done it, right? You're not just doing it this one time to try to get past
Yeah.
the whole qualification component, and you're going to quit the day after you close.
Can't apply for a loan in January for the Amazon job you just picked up in October, for deliveries for the holidays, unless you did it the year before.
Yep. So
then it's fine. So that's the seasonal job. It's the history. Because then it seems likely, yeah, they'll probably bring you back and give you another chance next round. And we're good with counting what you've done with that and factoring that average basically over those 2 years, in fact, is the best way to kind of think about that. So,
well, and it was always fun. You could tell when they were on their seasonal job or when they weren't, especially like the ones that would go out and go fishing. They would go out fishing and they would fish for like 3 months out of the year and they would slay it. And then they'd have all this other time that it was not a whole lot of income,
right.
But you could show that pattern in history, where they made $200,000 over the course of 3 months, years and years in a row.
I mean, it's the same, I don't know. It makes me think about those contractor jobs where you go overseas for 90 days and come back with $100,000 in your pocket.
Yep.
Like, is that seasonal? No, not really. It's the kind of
contract. That would fall under depending on how you're paid.
Yeah, it does depend. If you're a 1099, a whole nother story. Side hustles, guys. Not really a way to count that that's going to continue necessarily. But again, if it's a smaller side hustle that you're utilizing on your taxes, for example, a spouse that has a Mary Kay business and they treat it that way, and there's a couple extra grand a year in there and they've been doing it a while, we'll treat it as self-employment income and that kind of thing. But if you just make wreaths for the local farmers market every now and then and just get some extra cash out of that, there's if it's not being documented really in a tax basis, you can't really utilize it, especially if it's a cash business of any kind. It's pretty much impossible for us to really know what it is, how it looks, and that it's consistent and have there's no documentation. It's the bottom line there.
Yep.
Yep.
No, if you can't document it, it didn't exist, right? It doesn't exist.
And then second jobs, totally fine, as long as you have the history of having the second job. So it really comes down to that. And obviously a second job is probably not going to be an extra 40 hours on top of the 40 hours you're doing. Usually, I have seen it happen. We got to usually label one of them as primary and one of them as secondary. But if it's history in the field, the caveat for this, if you're working at Bed Bath and Beyond, part-time, and if you have 2 years of history, cool. That's fine. If you did it the 1 year, not enough time yet there. If it's, I'm losing my train of thought here. You got to help me save this.
What I'm hearing is a theme through all of this, that being able to document it with formal documentation and having that history in the past that we can actually see, and the likelihood that it's going to continue.
Yeah. So that if that second job is if it's in a field that you already work in, there can be some consideration I've seen for that. So if you are a nurse and then your second job is home health care and you're picking up extra hours and doing things like that, then I have seen some occasions where a little bit shorter amount of time could be considered for that if it's necessary.
Yep. So those are like when you get into compensating factors, things that really kind of help take something that might be just a little bit tight and say, okay, but there's these other things that make it a less of a risk.
Yeah.
Okay.
Yeah. And guys, when we're looking at how much you qualify for and all of that, I mean, every penny helps. Not every penny is necessary. So when you're giving your application and making your plan with a loan officer and kind of going, okay, here's what we think, and here's what we do, and here's how we work, and here's the money we make, then that's the time to open up with those things so we can consolidate that down and help you figure out a plan of, all right, what documentation are we really going to need? What do you have? And then how much do we need? Because if the primary wage earner makes enough money to cover the entire loan that you're thinking about taking on all on their own, Do we need to really worry so much about the second job that the spouse has that they've had for a couple of years? I'll probably put the information on the application, but we don't necessarily need to bother you with all that additional paperwork to chase it down if we don't need it. So just a caveat there, be open about your whole picture, but we may not need to get all of the documentation from you. It just depends on what you're trying to buy.
Yep.
We try and give a good general overview so you're not spending every penny you can spend on a house, because
No.
the VA will let you get in way over your head. Being at a 55 plus debt to income ratio is a very uncomfortable financial place to be. So we want to be responsible with that and make sure that that picture is comfortable for you. And
I like to be able to go have dinner, go on vacation. I don't want to go and buy this mansion
save for retirement a little bit.
and then not be able to enjoy life. And then all of a sudden I'm not happy about living there anymore because it's my jail.
Yeah.
It might be a big jail, but it's a jail.
You want to make sure your budget allows for steak now and then and not just ramen.
Yes, please.
Yeah.
Okay, so we've talked about employment income, whether it's military or civilian pay for your work.
Yep.
Now, you might be in a situation that you've got some passive income that might be coming in. So let's talk about what we see a lot with income sources that you might not, that isn't actually tied to employment. So I know that one that we see, right? We saw it in military on the retirement pay and the disability pay for the military, but we also see pensions and retirement and Social Security in the civilian world.
Right.
So tell me a little bit about those.
Well, we can definitely count them. Pensions and retirements are generally labeled as very likely to continue. They're going to keep on going unless there's a reason in that document that's provided for that income that it's going to end on a certain date. And it's within the 3 years really, then we're good with it. So the most stable financial people I meet generally that are qualifying for loans frequently are retired military who did a good job saving, utilized their TSP as well through that process, went into a government job of some kind, and then end up double dipping in retirement. You tack on 30 years of federal on your 20 years of military time, or vice versa, and you ease off into retirement, and then you have basically maxed what you're probably going to get out of Social Security on top of that when you file that in. You're living pretty comfortable and pretty and not really having to worry about paying your bills. So
Agreed.
Yeah.
Social Security, can we use that?
Yes. Yeah. Social Security is deemed to be continuing. You earned it, you paid into it the whole time. So if you're at that age where you can turn it on, yes. The other type of Social Security we're going to see, of course, is disability. So disability with Social Security, as well as VA disability, they're looked at the same way, basically, hand in hand, the same thing, likely to continue. The other side of that, what we occasionally see, of course, is that some of you may have disabled children who receive Social Security disability, and we can count that because you're their caretaker, and we know that that is income coming into the household. So getting a house and roof over that person's head is equally important, and we can look at that too. So that's fine.
Okay, so these we see fairly often.
Yep.
Let's talk about some of the ones that for that population, again, that may have planned well, that are now retired in all likelihood.
Yep.
But some of the other income, the couple of main income sources we see there, and when we can and can't use them. So if you've got lots of investments, if you've done a good job saving and putting that money away, then can you use the dividends, capital gains, and interest that you are receiving on those investments?
Yeah, it can be looked at a couple ways. So, and guidelines change on this a little bit here and there, and sometimes it's company dependent upon what they will look at for that in particular. But if you've set up an annuity and you have ongoing income from that, fine. You get into the age bracket where you can have regular and steady withdrawals from IRAs or your TSP or any of those sorts of things. Absolutely, we can use that. And I have had occasions where, somebody just had substantial assets. They had an inheritance. They just, had 300 or 400 grand in the bank, sitting in whatever money market account that they had ready. We had them, we knew what they needed in additional income on top of their retirement piece that they had, and they only had a military retirement at the time, but they had this other piece. And so they set up an ACH withdrawal. He didn't want to do that necessarily, but we showed one-time receipt of an ACH withdrawal from that account, and we can utilize that as likely to continue steady income moving ahead, because we see the chunk of cash that is there. Now, after closing, if he doesn't want to continue to receive that distribution, that's absolutely their call to change at the time, but the money's there if they needed it, is the point. They can tap into that if they need to make their payments. So we can use it.
And that is actually called asset dissipation.
That's right.
And it is taking a look at that entire amount and figuring out over the course of, depends on the loan program. It might be that they look at it, it has to be able to continue for the next 15 years, what that dollar amount is. It might be that they're going to require that you kind of do the math to figure out what that would look like if you distributed it over 30 years, and that's the amount. So it kind of depends on the loan program, but it is feasible on whether maybe it's $60,000 you have in the bank.
Right.
Maybe it's, the $600,000, but being able to do that asset dissipation on non-retirement accounts, unless you are of retirement age, right? Because of the actual ability to get penalized and that on those. So it is on non-retirement 401k kind of deal there.
Typically that would be the plan. Yeah, we don't want to necessarily put you into a game plan to start having tax penalties for withdrawing early.
No.
Yeah.
IRS does not get any more of my money than they absolutely have to.
Right. Yeah, we all gave enough to Uncle Sam.
Then the other one that for those that have used buying a home, maybe they used their VA loan a couple of times and they have rental income. They've got rental properties, investment properties. Can you use rental income?
100%. Yeah.
100%. Always? Forever?
No, I mean,
You may, okay.
not always. Depends on your history. Depends on your history. So if it's a leaving property, like maybe you bought a house with your VA loan the first time and you're leaving that house, and you're going to buy your second house using your VA loan or whatever loan you want to use, we can utilize the rental income from the property you are leaving to offset that mortgage debt. So here's what I mean. We can count 75% of that rent to offset the existing mortgage on that. So we can kind of wipe the slate clean, so to speak, on not having that mortgage impact you on a negative basis.
And that's on your departing residence, and it's going to be dependent on the loan program. Some will let you do that. Some historically haven't. Some are easing back up on those. So it's going to be dependent on the loan program. But on that departing residence, in many cases, you can use that rental income to offset the debt, which means it's not hurting you in your debt to income ratios on the new property that you're buying.
Yeah. Now, looking ahead, if you have been planning and you have purchased a few investment properties, you've made a few of these moves, if you have a 2-year history of receiving rental income, then we can dig deeper and utilize that rental income, not only just to offset the debt on those, but as income. Maybe you had the money and you just paid cash for a little place and you fixed it up and you rented it out and you're getting $1,000 a month for it, and it's paid for. We're going to
and it's on your tax returns.
Yep, and that's there, and that's it. Yeah, that's a massive key. Are you putting it on your tax returns? If you're hiding it, then we don't see it, basically. So,
and again, it goes back to that ideally for your tax returns to be able to be, it's that 2-year history, right? And again, averaging that over those 2 years as to the likelihood of what that continuing income is going to be. It is interesting. There are some, if you are buying an investment property, now, if you're buying an investment property to be a rental, you've got a lot different requirements on income and what can and can't be used and whether you can use it at all. If you don't need to offset the debt, then it's irrelevant. Your income that you bring in more than covers your house payment, all the other debts you have, and the payment on the rent. Yeah,
you're fine.
But if it doesn't and you need rental income, a lot of loan programs require that you show that you actually have landlord experience before they let you use it.
Exactly.
So being able to, anytime you have the opportunity, think ahead I think I might be doing this. Let me do some research. Let me have some conversations with some experts and figure out what I can and can't use so that you don't find that house, get halfway to the closing table and realize, hey, Houston, we've got a problem.
Yeah. Yeah, and we do have occasions where we'll have a vet buying an investment property, and if they have the history of being a landlord and it's there, if that property is already rented and there are leases in place, we can use the income being received by the person selling the house currently towards qualifying for the purchase of that property. But you got to have the history. If you don't have the 2 years history of managing property, guess what? Who knows if you're going to be a good landlord? We don't have enough proof to know that that's likely to continue. You could be the worst landlord ever.
So again, I'm hearing this
Total thing.
repetitive thought here that 2-year history
Yeah.
and likelihood of continuance
That's it.
are really important. Okay, which then actually takes us to the unique situation that we deal with military, and that is when you are transitioning out. And this really sneaks up on people. The number of families that I talk to and the number of service members that I talk to that are like, what do you mean? This is what I make. I can't use this. And it's when we know that within 12 months that you are either separating or retiring from the military, we
know there's a drop dead date on that income. I mean, that's the bottom line. It's one of the few jobs out there, if you think about it, that just, all right, at this date, you're no
done.
longer out. You're not going to get that income. So all the lender cares about is, do you have the ability to repay, and are you likely to be able to continue to do so? That's what gives them the confidence to push a couple $100,000 across the table to you. So in that circumstance, when you're moving towards that, you guys got to start talking to somebody prior to your 12-month point. If you got a year left,
Yep.
I highly recommend you consult with somebody like us that can sit down and talk about your plan and where you're going to go and how are you going to get there and what income can we utilize, because there's a lot of unknowns right there. So we've already talked, we can touch on the retirement piece. We can't use your ongoing income that you're actively receiving because that's going to end. So we can probably look into the retirement and count that. That should be okay. But more often than not, that's not enough to really just get it done if we're really being realistic with today's home prices. So what's going to happen? How can we utilize it? What can we utilize? How do we do that? So one thing to know about the VA loan is that you have the right to house your family wherever you want, ultimately. So if you are getting out and you know it's going to be some time away, you can go through the process. I'm thinking through this, that if you're prior to your 12-month point, you can house your family at the house you think you're going to go put them at. They have to occupy within 60 days.
they have to go.
They got to go, unfortunately, but we've been through those separations. So sometimes that's the best plan with that. So the other side of the coin leads us into, what are the other options, Michelle?
So when I start having this conversation, and I've done a couple of podcasts regarding just the whole transition component, and that is like, today, if I'm active duty today, I know what my bank accounts look like, I know what my debt looks like, and I know what my income is. But tomorrow I'm retired. So I go to bed tonight, I know these things. I wake up the next day and I am now out of the military. I know what my bank account still looks like. It didn't change overnight. I know what my debts are. They didn't magically disappear, but my income is now gone. And that's what becomes important as we talk about what it's going to look like in the future when you're within that 12 months.
Yeah.
So a couple of examples, and I find examples are really great ways of bringing all of this together. And I like using myself occasionally. So when my husband retired, we knew his retirement. That's great. And we knew his disability.
Okay.
Wonderful. Those could be used.
Right.
But his income couldn't. And the job that he got, he opened an LLC, started an LLC.
Okay.
LLC. All of a sudden, I'm thinking
Self-employed.
self-employment income. And he is doing some independent contracting in the LLC and started a fishing charter business. Okay. So we went from having 2 incomes to 1 income, retirement and disability, that didn't come close to what his actual income was on a
Right.
monthly basis.
Right.
And then the jobs that he decided to do, we couldn't count for 2 years.
Right.
So we needed to think far enough ahead to know exactly what we wanted that situation to look like, instead of finding out when we wanted to do something that we couldn't.
Right.
And trying to understand that.
So what did you do?
Fortunately, we didn't need to buy a house.
Okay.
We didn't refinance. There was
Okay.
a time that we looked at, I was like, oh, well, we could refinance. And well, we couldn't, because the income wasn't there to allow that particular refinance at that time.
Got it.
Now it's been 11 years. We can do whatever we want.
So when you're looking at jobs that are going to begin when you get out, if we're also being realistic, a lot of times those don't start gelling up until 6 months prior to getting out and all of that. So if we have a strong offer letter and it's something that, makes sense, then we probably are okay. Now, if you've been a Teams guy your whole life and you're doing all these things and it's time to get out and you got 6 months left and you're going to go start an animal rescue, or work for one, for example, that may be a little tougher, because there's a whole different thing. If I'm a lender right now, and I that's what I've been doing forever, and I am planning to go buy a house and I become a welder, I'm going to need to establish some history as a welder before I could utilize that income. So it's helpful to have some continuity of tying together some of the new job with that, and that could be tied to education as well. So if you had training and education in a certain field and now you're maneuvering out and you're going into that field, that can be something that we can look at, those letters of offers of employment without contingency, so that we can go, okay, this is what the income is going to be when it picks it up. Now, some lenders out there may have their own overlays or rules, and they may want to see that you've started on the job. Some of them may want that first pay stub or even 2 before they're going to close out on that deal. So that has to be, again, a part of your planning in all of that, and gets into some deep conversation and planning for that transition. It's not the easiest thing to do. So the earlier you can start planning for it, cannot encourage that enough. You got to think a couple years ahead when you're approaching the end of your military career, whether it's a retirement or whether it's just, hey, I've had enough and I'm getting out. We all know that happens. Not everybody's going to go 20 or more. So if you're thinking about that and you're getting to the point where you're really game planning where you're going to go and how you're going to do it, the earlier you can plan for that, the better. Now, if you're going to stay put in the area that you're at, for what it's worth, let's just say you live here in Virginia and you like it here. You've been here for a couple of years. You have 18, 20 months left on your current contract, but in your heart, basically it's really your intent to get out. More than likely you're ready to do that, but you're happy to be here. Well, you're not within that 12-month period. So we're good. We're going to count your current income. We're 100% good. We are all set there. If you do break into that 12-month period, there is a little bit of a gray area here that I'll just mention. And that is basically, if you are eligible to re-enlist still, and you are willing to sign a letter stating that that is your intent to the lender, that you're going to re-enlist, then they will count that as a likelihood to continue for your current income. They've said you're eligible, as you've said that's your intent. People change their minds for what it's worth. So again, the earlier you can make the plan, the better. Prior to 12 months, this is easy time if you're going to be where you're going to be. Now, if you're in Virginia, had enough of this joint and you're going to Colorado, you're ready to get the heck out of here, that's a little tougher, because do you have orders to there? How do we know you can go how do you know you're going there? Like, we don't, that's not going to fly. And so that's a whole nother story. So you really got to plan. You gotta
Plan and have conversations. Do
Yeah.
your research, do your homework, do your workups. Make sure you know what's going on.
That's it.
Absolutely.
Yeah. Yeah. And have a plan for what the income is and to determine that and know the market that you want to be in.
Mhm.
That's the other side of the story. If you know your income and what out of all of this we're going to be able to utilize at the time that you want to buy something, and we can't predict rates, but we can kind of have a ballpark. Right now, we're moving up right now. But where that's going to land or settle out, who's to say right now? But in that longer term planning, maybe we give that padding to, okay, well, what if interest rates were higher and all of that? Well, if you want to move into Denver, you're going to have a pretty solid income. Their inventory is very low. The prices there are outstandingly high. If you're getting out of here and you're going to outside of Nashville, it's a whole nother market.
Mhm.
You know, affordability is different. So if you know your income and what it's likely to be, that may help you decide where to go for what it's worth. It isn't always going to be home. It may just be the place that you can secure work and buy a house that you can afford and comfortably live your life with what happens. And then you can grow from there once you start settling into that transition life.
So as we look and talked about all of this, a couple of things ring true, right? So if you're transitioning, not only do you need to think about the time frame, but you need to think about the type of work. Am I going to be a W-2 employee? Am I going to be self-employed? Am I going to be an independent contractor, right? Because all of that's going to play into how quickly that can occur, which all circles back to that underlying theme tonight, which is the stability of the income, i.e., what has been the history and what is the continuance look like. Both of those are one of the number one thing in determining whether income can be used for qualifying or not. Is that fair?
Yeah.
Okay.
Yeah, absolutely.
So we have a couple people that hung with us that are on live. If you have questions, feel free to pop them in. But if you're watching this later, we are so glad that you did. Hope that you found some great information in here. We want your feedback. Let us know what information you liked, what you didn't, what you'd like to hear. Speaking of what you'd like to hear, as we are planning these every month, next month, and we are now going to be doing these, I believe, the first Wednesday of every month. Same time, same place, same bat channel, all of that. Yep. We are actually going to be talking about wealth building next month, making the investments that you have work for you. We're going to have some guests with us, a financial advisor and a real estate agent. They're going to be able to talk about savings and retirement and the different vehicles that are out there to help you with that.
Awesome.
So really excited about that, guys.
Good. Yeah.
Then with that, I'm going to hand this back over to Dave. I'm going to stop sharing and come back. Oh, and we are putting in the chat, guys, as well. Let me do that right. I'll do that here in just a second.
You can find us, guys, real easy. It's benjamin.smith@caliberhomeloans.com or michelle.crumley@caliberhomeloans.com.
M.Crumley. There's two
It's
Michelle.
M?
There is two Michelle Crumleys.
M.
Yes, a Caliber. It's
M.
hilarious. I have a doppelganger.
I've been meaning to talk to Caliber about just buying caliber.com. It'd be so much easier than Caliber Home Loans. But we appreciate you guys. And our contact info will be, I'm sure, in the email if you have a call or a question that you want to make.
And I'm dropping it in the chat.
Yeah, we're easy to find. Thank you so much for paying attention and listening if you made it through all of this. I know it's a little bit of a dry subject and it's hard to kind of sex that up for you guys a little bit, but we do want to make sure that the main thing is that you know how to make a plan and to connect with people who hopefully know what they're talking about for you, no matter what market you're in, no matter where you're going to go. If you need assistance finding somebody, all we care about is that we land you with professionals that can look out for you and your family's best interests. So, Dave, it's all you, sir. Thank you so much.
Well, Ben and Michelle, we really appreciate your second seminar there. Very insightful and certainly information we can all use in our home buying endeavors, and really appreciate everything that you guys are sharing with us. And we look forward to our third seminar in March. And for those of you who have stayed with us online, we really do appreciate it. And if you happen to want to go over the material, we'll hang it on the UDT Seal Association Facebook page. So thank you very much and have a great night. Talk to you soon.
All right, thanks, guys.
Thanks.